Hey, welcome back. The laws written to protect banks, not people. In 2008, when the global financial system came dangerously close to collapse, millions of ordinary people lost their homes, jobs, and life savings. Yet, in a twist of irony, the very institutions that had created the crisis were the ones bailed out, rescued by laws and policies that seemed tailor-made to protect banks, not the people they served. But this wasn't some sudden accident of history. The truth is, banking giants have been shaping the laws of nations for centuries, ensuring that when storms came, they had a lifeboat while everyone else was left to drown. To understand this imbalance, you need to rewind centuries back to the birth of modern banking. It begins in Renaissance Italy, where the Medici family ran one of the most powerful banks in the world. They weren't just moneylenders, they were kingmakers. Popes, monarchs, and merchants all depended on them. And here's the clever part. They learned early on that laws could be bent, or even written outright, to favor their trade. When the Catholic Church banned usury, the Medicis found loopholes, disguising interest payments as fees or gifts. What looked like morality on the surface was, in reality, a system tailored to let banks keep thriving. Fast forward to the 1800s in America. A man named Nicholas Biddle ran the Second Bank of the United States. He wasn't elected. He wasn't a politician, but he had more influence over the economy than almost anyone else in Washington. When President Andrew Jackson tried to dismantle his bank, calling it a monster that put private profits above public good, Biddle fought back. He tightened credit, caused economic panic, and proved a chilling point. If you strike at the banks can strike back harder. Laws meant to regulate finance often ended up ensuring banks could never fully be toppled. By the early 20th century, J.P. Morgan took this to an entirely new level. Morgan wasn't just a banker, he was a shadow president. In 1907, when the stock market spiraled into crisis, Morgan personally gathered bankers in his mansion and forced them to cooperate to save the system. It worked, but it also cemented an idea that persists even today. When the economy falters, banks are too important to fail. And when something is too important to fail, the laws will bend to keep it alive. Out of this era came the Federal Reserve in 1913, a central bank designed to prevent future crises, but also a guardian that ensured private banks had a permanent shield. But perhaps nothing exposes this reality more clearly than the events of 2008. Banks had created toxic mortgage securities, selling them as safe investments while betting against them in private. When the house of cards collapsed, ordinary people bore the brunt. Unemployment shot up to nearly 10%, 8 million homes went into foreclosure, and retirement savings evaporated. Yet, banks like Citigroup and Bank of America received billions in government bailouts. The justification was chilling in its simplicity. If the banks failed, the entire system would fall. And so, laws like the Emergency Economic Stabilization Act were rushed through Congress, funneling $700 billion into Wall Street survival. What about the people? Homeowners got complicated relief programs riddled with loopholes. Students saddled with debt got little mercy. The contrast couldn't have been clearer. When banks stumble, governments rewrite the rules to protect them. When people stumble, the rules remain merciless. And this wasn't just about one crisis. The laws protecting banks are often subtle, woven deep into financial codes and regulations. For instance, bankruptcy laws in the U.S. are more forgiving to corporations than to individuals. A person drowning in student debt cannot easily walk away from it, but a bank that makes reckless bets can restructure, reorganize, and, with government blessing, return to profit within a few years. In fact, by 2010, just 2 years after the crash, Wall Street profits were soaring again, while average households were still struggling to recover. But that's not the full story. Behind the laws lies something more powerful: influence. Banks spend billions lobbying politicians, funding campaigns, and shaping public opinion. In 2022 alone, the financial industry spent over $600 million on lobbying in the U.S. It's not charity, it's insurance. Insurance that when the next crisis comes, and it always does, the system will choose to save the banks first. And here's a paradox. People resent this, yet they also depend on it. Imagine waking up tomorrow and finding your ATM doesn't work, your paycheck doesn't clear, and your savings vanish overnight. The fear of that chaos is what makes governments step in again and again to shield banks. The laws, then, are not written with morality in mind, but with survival. Not justice, but stability. So what legacy does this leave? On one hand, banking empires continue to dominate global finance, bigger and stronger than ever. JP Morgan Chase, Goldman Sachs, HSBC, their names carry almost sovereign-like power. On the other hand, public trust erodes a little more with each crisis. People know, deep down, that the game is rigged. The rules apply differently depending on who you are. The lesson, if there is one, is sobering. Banks have mastered the art of embedding themselves so deeply into the lifeblood of economies that their survival is synonymous with society's survival. And because of that, the laws will always bend to protect them. But every bend has a breaking point. History suggests that when the gap between institutions and the people they serve grows too wide, revolutions, financial or otherwise, are not far behind. If you enjoyed this story, leave $1 in the comments.